Picture this scenario. You have completed a job. You send the invoice. The client has 30, 60, sometimes 90 days to pay. Meanwhile, your materials supplier wants their money now. Your staff need to be paid this week, and another job has come up that you need cash to take on. You have done the work. The money is owed to you. It just has not arrived yet. This is exactly the problem invoice finance is designed to solve, and it works differently to a traditional business loan in a way that makes it the right tool for this specific situation. When you raise an invoice for a client, instead of waiting for them to pay in 30 or 60 days, you submit that invoice to an invoice finance lender. The lender advances you up to 85% of the invoice value, usually within 24 to 48 hours. The remaining 15%, minus fees, is paid to you when your client settles the invoice. You get the cash now. Your client pays on their normal terms, and you are not taking on a fixed term loan with regular repayments. That distinction matters. With a traditional business loan, you borrow a lump sum and repay it in fixed weekly or fortnightly installments, regardless of what your cash flow looks like in any given week. With invoice finance, the repayment happens automatically when your client pays, which aligns perfectly with the cash flow cycle of your business. Invoice finance is particularly well suited to businesses that do commercial work. Subcontracting, business-to-business services, trades working for builders, healthcare providers, billing insurance funds, logistics companies, manufacturers. Anywhere there are invoice payment terms and a gap between completing work and receiving payment. Now about what it costs. Invoice finance lenders typically charge a percentage of the invoice value, usually between 1% and 3% per month, depending on the lender, your volume of invoices, and the creditworthiness of your debtors. Because it is structured as a fee rather than an interest rate, it can look more expensive on paper than it actually is in practice. Compare it to the real cost of a cash flow problem. Missed opportunities, late supplier payments, or a short-term loan to bridge the gap. For many businesses, it is the cheaper option. There are two main variations worth knowing about. Disclosed invoice finance, sometimes called invoice factoring, means your clients are aware their invoices have been financed. Undisclosed invoice finance, sometimes called confidential invoice discounting, keeps the arrangement private between you and the lender. Your clients pay as normal and never know the invoice was funded. To qualify, the standard requirements are an active ABN, minimum monthly invoicing volume, and invoices raised to creditworthy business clients rather than individual consumers. Approval typically happens within a few days for a new facility. If you are experiencing the cash flow gap between completing work and getting paid, invoice finance offers a way to access the money you have already earned without waiting for payment terms to expire. It turns your outstanding invoices into working capital when you need it most.